Hey there! Welcome to Principal and Profit. Starting a finance journey can feel like trying to fold a fitted sheet, confusing and slightly aggressive, but today we're breaking it down so you can actually build some wealth without the headache. Let's talk about Isaac Newton. Yes, the guy who figured out gravity. Even he wasn't smart enough to avoid the severe consequence of speculation. He lost a fortune in the South Sea bubble because he followed the crowd into a hot prospect. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." The consequence? Usually a portfolio that looks like it went through a paper shredder. On the flip side, the legends, like Warren Buffett and his mentor Benjamin Graham, focus on the longevity of a business. They don't look for miracles, they look for consistency. They treat the future as something to be guarded against, not just a place to find easy profit. Today, we're drawing the line between building a fortune and gambling it away. So, what does it actually look like to invest? According to the philosophy of Benjamin Graham, an investment operation isn't a guess. It's a process, and in order to achieve a successful investment operation, we should adhere to the following guidelines. 1. The deep dive into the business. You aren't just buying a ticker symbol that looks cool. You are buying into a whole business. You need to understand what they do, how they make money, and why they'll still be around in 10 years. A fundamental question to ask yourself when investing is, who is the business's target market, and will that market exist indefinitely? 2. The financial statement audit. This is your due diligence duty. You're looking at the Holy Trinity, the balance sheet, income statement, and cash flow statement. You want to see if they actually have money or just a lot of colorful PowerPoint slides. Subscribe to the channel and comment down below if you want to learn about evaluating financial statements the buffet way. 3. The management check-in. You wouldn't let a toddler drive your car, so why let a questionable CEO direct your money? Knowing who is managing the company and keeping up with their decisions is a core part of an investment operation. 4. Guarding the principal. Most people think investing is about making money, but true investing is about not losing it. You evaluate the company to see if it can maintain its earnings so your original principal stays safe. Here are the 4 indicators of an investment operation. 1. Consistency in low to no debt. 2. Consistency in growing sales. 3. Constant cost of goods sold. 4. Constant costs for research and development and growing earnings. Now, let's look at the dark side. Speculation often feels more exciting, kind of like a first date, but it's usually built on prospective developments rather than reality. The following guidelines help us understand what a speculative operation is. 1. Chasing the next big thing. Speculators rely on announced or planned future projects. They are betting on what might happen, rather than what the company has actually proven it can do. 2. Ignoring the track record. This is the 10th place athlete syndrome. If a company has been failing for years, a speculator ignores that past performance and hopes for a miracle pivot. 3. The price-only decision. If the only reason you're buying is because the stock price is going to the moon, you're speculating. You're relying on the market's mood rather than the business's value. 4. The gambling outlook. Speculation and gambling share the same DNA. Both are focused solely on favorable future prospects without any safety net for when things go wrong. Here are 4 indicators of a speculation. 1. Justification based on prospective developments that differ from the past. 2. Relying on planned future projects instead of current results. 3. A lack of consistent earnings on the income statement. 4. Focusing on probable outcomes of news rather than the actual results of the business. The bottom line? While we can't predict the future, we have the past to show us the most likely outcomes. Investing is about security against an unfortunate future. Whether you are investing for appreciation or cash flow, you have to invest in companies that will secure your principal value and also beat inflation through steady, consistent growth. And I want to hear from you. Have you ever speculated on a stock because of the hype, only to have it crash? Or are you a strictly by-the-numbers investor? Let me know your biggest lesson learned in the comments below. If you found this breakdown helpful and want to keep building that investment mindset and leave the speculation to the gamblers, hit that subscribe button and ring the bell for more wealth-building tips. I'll see you in the next video.